Here's the script rewritten in simple, friendly storytelling style. Okay, let's get into it, because Sunday evening before a Monday open is exactly when the signals matter the most. Mexico is in crisis right now, not the kind of slow-burning crisis that takes months and months to build up, the kind that moves fast and hits hard. The military has been mobilized, airspace has been shut down in parts of the country, flights have been canceled, and right at the center of it all is a significant operation that reportedly took out one of the most consequential cartel leaders in the country's recent history. The details are still coming in, and I'm not here to guess at the political side of that story. What I am here to do is connect the dots that the financial media will absolutely not connect for you. Mexico is the single largest silver-producing country in the entire world. Roughly 1 out of every 4 ounces of silver mined globally comes right out of Mexican soil. That's not just a fun little fact. That's a structural reality that makes any significant disruption in that country a direct hit to global silver supply. Road blockades, logistics delays, airspace restrictions, none of this creates an instant collapse in supply. That's just not how mining works. But here's the thing that actually matters. This market is already structurally tight. We covered in the last video how speculative long positioning in silver was sitting near 20-year lows, even as prices were making aggressive moves. We covered the Shanghai premium already signaling physical demand running ahead of the paper price. An already tight physical market does not need a full supply collapse to reprice itself. It just needs uncertainty. And right now, uncertainty is exactly what Mexico is pumping out in real time. Silver is not priced for supply shocks at all. The paper price at $84 reflects a market that's just assuming supply keeps flowing normally from the world's largest producer. Physical first, paper later. That order of events matters a lot. And the ones who understand how commodity markets actually respond to supply disruptions understand why this headline deserves way more attention than it's currently getting. Now, let me bring in the gold-backed crypto signal, because this directly answers the question a lot of people woke up asking today. PAXG, the gold-backed token that trades 1-to-1 with physical gold, is currently showing a $50 premium above Friday's Western closing price. Gold Western spot closed the week around $5,098. The token is pricing above that right now on a Sunday before Western markets have even opened. So what does that actually tell us? Crypto markets trade around the clock every single day. Gold-backed tokens like this one basically function as a real-time stand-in for gold sentiment when the traditional markets are closed. When you see a $50 premium developing on a Sunday evening before Monday's open, what you're watching is market participants bidding up gold exposure during hours when they literally can't access futures or spot markets directly. That is a forward-looking signal. It's not a guarantee of anything. Markets gap and fill, liquidity plays tricks, and one instrument's weekend pricing doesn't write the whole script for Monday's institutional open. But it is directional information that the informed minority pays close attention to while everyone else sits around waiting for CNBC to explain what happened after the fact. If gold follows that signal, the level to watch is the previous week's high. Specifically, the high set on Wednesday the 11th of February, which also represents the prior weekly high. That's the structure gold needs to clear to confirm that momentum is continuing. Now, I want to be very clear about something here. This is tape reading education for people who do short-term trading. I am not calling a price. I am not giving you a signal. I am showing you the structure as it currently exists, because understanding how professional traders read price action is part of the financial warfare education this channel was created to provide. One really critical context point here that completely changes how you should interpret any Monday move. Shanghai remains closed on Monday. It reopens Tuesday. That means liquidity is going to be lighter than a typical Monday session. Thinner liquidity environments can amplify moves in both directions. A gap up in gold with Shanghai offline could look way more dramatic than the underlying demand actually warrants. And a reversal in that kind of context can be equally sharp and sudden. The ones who trade short timeframes really need to hold that in mind. Light liquidity is not confirmation of anything. It's a condition that demands more caution, not less. On silver's structure specifically, the lower timeframe picture is still intact as of this recording. The next objective the tape is pointing toward is $86.30, which also happens to line up with a prior weekly high. That's confluence. When a technical level and a structural market memory point line up at the exact same price, it carries more weight than either one would carry by itself. Above that, there is a resistance zone spanning from $87.20 all the way to $89, and this is important. That zone is not a ceiling to slowly grind your way through. If silver enters that range and just sits and consolidates, it loses momentum. What needs to happen at that level is decisive force, price moving through it with volume and conviction, not spending time just camping inside it. Again, this is tape reading for the people working shorter time frames. Not a signal, not advice, just the structure as it reads right now. Now here's the mid-reveal. the layer that connects all of this to something much larger than a Sunday night premium or a Mexican airspace closure. We talked last video about the dollar's share of global reserves hitting its lowest level in 32 years, central bank gold holdings now exceeding treasuries for the first time since the mid-90s, and the COMEX delivery situation that's been quietly developing in the background. Let me add to that now. With 4 days left before last notice on the February gold contract, the remaining open interest represents over 436,000 ounces, roughly 13.5 tons of gold. That is 24 times the average open interest you'd expect to see at this point in a delivery cycle, and more than double the largest prior contract at the same stage. The February open interest is actually larger than the upcoming March contract. That has likely never happened before in the recorded history of this market. What that pattern typically signals for those who've watched COMEX delivery cycles over many years is a short that has been holding these contracts since first notice day, hoping to close the position, and instead finding themselves with absolutely no exit as liquidity dried right up. Volume on Friday was just 134 contracts. That is not a liquid market for someone trying to unwind a position of this size. The uncomfortable question that raises is pretty straightforward. Does this short actually have the physical metal to deliver? If the answer is no, the playbook from prior episodes of this exact pattern involves one of the major bullion banks stepping in to issue delivery notices in the final days, which creates its own kind of disruption. The physical market is tight. The COMEX structure around the February contract is anomalous. And we are heading into a Monday open, where gold-backed crypto is already pricing a $50 premium before Western institutions have even opened their terminals. G. Edward Griffin documented in Creature from Jekyll Island how concentrated short positions in paper gold markets function, not just as trades but as structural tools for managing price. He was dismissed as a conspiracy theorist when he wrote it. Since then, we've seen the J.P. Morgan precious metals settlement, $920 million, September 2020, and documented CFTC enforcement actions that confirmed exactly what he described. The pattern he identified in historical context is not theoretical anymore. It has case numbers, it has settlement figures, it has admissions of guilt. And what we're watching in the current February contract open interest anomaly rhymes with every prior instance where a naked short found itself trapped with no physical metal to deliver and no clean way out. The geopolitical backdrop adds another whole layer that the financial media is actively choosing not to connect to metals pricing. The situation with Iran has not resolved, it has reclassified. The US has indicated acceptance of Iran's right to maintain uranium enrichment. That sounds like de-escalation on the surface, but it isn't necessarily. Military assets, significant military assets, have been moving toward the Middle East in numbers not seen since 2003. When you move that kind of hardware toward a region, and then accept a diplomatic proposal, you don't automatically pull the hardware back. The strike risk has not been eliminated by the negotiation. It may have simply been paused. Markets that are pricing metals at these levels are partly pricing geopolitical tail risks that haven't resolved. They've only moved from front-page news to background noise. And in the background of all of this, a monetary regime shift is quietly accelerating. Since the 1970s, global currency reserves have been anchored to US dollars and treasuries. That structural demand allowed the United States to run persistent deficits while exporting inflation to other countries. Foreign buyers absorbed the treasury supply and financed American consumption. The seizure of Russian reserves changed that whole calculation fundamentally. Countries that once treated dollar reserves as a safe harbor now understand that those reserves can be weaponized against them. Central bank gold holdings exceeding treasuries for the first time since the 90s is not a coincidence. It is a documented, measurable response to that risk recalculation. And as more central bank demand shifts toward gold instead of treasuries, less of the inflation created by US deficits gets absorbed externally. More of it stays inside the domestic economy. That is not a theory, that is arithmetic. Jim Rickards laid out this exact dynamic in Currency Wars. How the dollar's role as reserve currency allowed the US to effectively tax the rest of the world through seigniorage and inflation export. And how the moment that privilege is seriously challenged, the inflation that was always being created comes right back home. We are watching that mechanism activate in real time. Now let me give you the honest case against the immediate bull thesis, because intellectual honesty is what separates this channel from every metals hype account you've ever come across before. Lighter liquidity on Monday, with Shanghai offline, is a double-edged condition. If the gap up materializes, it can reverse just as fast in a thin tape. The Mexico situation, while structurally significant for silver supply, has not yet produced a documented quantifiable reduction in mine output or shipment data. The cartel disruption risk is real, but it's not yet a supply shock. It's a supply shock risk. Markets can price in that risk and then fade it quickly if the situation stabilizes. The February COMEX anomaly, while statistically unprecedented, has produced bailout resolutions in prior episodes without a full market dislocation. The bullion banks have managed similar situations before. That doesn't mean they can manage this one. But dismissing that possibility would be intellectually dishonest. And for all the analyst targets floating around out there, the ones calling silver to hundreds of dollars, gold to 5 figures, ratios implying silver at prices that would require a complete monetary reset. Those projections are based on historical precedent and balance sheet math that is genuinely valid, but valid on timeframes that may extend well beyond most people's patience or planning horizon. Howard Marks in Mastering the Market Cycle wrote something that should be tattooed above every precious metals trader's screen. Being right about the direction and being right about the timing are two entirely different skills, and confusing them is how people with a correct thesis still end up losing money. Here is what all of this means when you put it together. Mexico has introduced a genuine supply uncertainty into the world's largest silver-producing country at exactly the moment when physical silver is already running a structural deficit and COMEX registered inventory sits well below the open interest demanding delivery. The gold-backed crypto premium before Monday's open is telling you something directionally, not definitively. And the structure in gold points toward the prior week's high as the first real test if that momentum follows through. Silver's tape is intact with 86.30 as the next structural objective, and a resistance zone above that which needs to be cleared decisively rather than slowly absorbed. Shanghai's reopening is going to be a key moment. The first price discovery from the world's largest physical silver market after a week offline, returning into a landscape where Mexico is unstable. Iran risk has not been eliminated, and the COMEX February contract is sitting in historically anomalous territory. The monetary regime shift isn't some future event to prepare for down the road. The data is showing it happening right now. Central bank buying, dollar reserve share at 32-year lows, COMEX delivery stress, a Shanghai premium that's been persistently elevated. This isn't speculation, it's a pattern that the ones who verify their sources have been watching build for months. This is financial warfare education, not advice. Verify everything I've shown you. The COMEX delivery data is public. The COT positioning is public. The Shanghai premium is public. The ones who check those primary sources will understand why what's happening right now is not noise. Invest with logic, not hype. OG out.